What's up, guys? Welcome to another episode of the CryptoKreamers. Today, I'm back with Ethan Vera, the founder of Luxor, and I'm with J. Paul Barrick, and you're with JP Mining. Is that correct?
JP Barrick with Mining Store.
JP Mine. Oh, my bad. JP Vera. Wait, JP. Okay, JP with JP Mining Store. Awesome. Welcome, guys. How you doing?
Doing well.
Thanks for having us on.
Cool. Dude, so you guys have any crazy fucking quarantine stories?
No.
I've been kind of hunkered down. Yeah, it's in Vancouver right now. There's very few cases, so.
Oh, okay. Cool.
Nothing crazy here, like you getting COVID.
Yeah, bro, Miami's fucking going nuts, man. It's like the new hotspot. So dude, it's fucking crazy, bro. Like, you go to Miami Beach. Like, I went to Miami Beach this morning to like pick up some food and bring it back here. And bro, it's just all the streets, they're just abandoned. It's just like fucking empty. But some of the restaurants are still open for pickup, so that's good.
It's good to hear. It's definitely hit the economy really hard. Like, I was reading that just in 2020 alone, in June, our budget deficit was $800 billion.
Oh yeah, I saw that. Fucking crazy. Anyways, let's talk about something more positive. Fucking Bitcoin. This is why we're all fucking here. Crypto, or whatever your poison is. So JP, tell me a little bit about yourself, because I know Ethan's story. So I want to know about you, man.
Yeah, so I got into cryptocurrency back in 2013. Started a Ethereum mining farm, running a couple hundred GPUs, and started mining Ethereum close to like $2 or $3. From there, scaled up, helped people build mining operations, helped people deploy mining facilities, all the way from solar farms to people building in data centers to working with waste management companies and using their energy. Currently, we have 7.5 megawatts under operation, and we're looking to scale up for like another 50 to 100 at some new sites where it's some low power costs. So that's a little bit about me. And I met Ethan through mutual introduction this year, and Ethan and I have been talking a lot about hash rate and how the US dollar per terahash is a metric that we want to educate people on and explain to people why it's important and why they should be aware of this new and up and coming marketplace.
Awesome. So, man, first of all, I want to say, like, dude, you got into mining fucking 3 years before me, so I'm kind of jealous. Second of all, dude, it's fucking awesome to talk to a fellow miner, and obviously it seems like you're a bit bigger than me in terms of the operations that you said you started in GPU mining. Is that correct?
Yep, GPU mining Ethereum in North Carolina.
So, dude, I have a suite. So my operation's in South Carolina, in this small little town called Barnwell. But before that, and I'm sure this would interest you, I started in Venezuela, and basically the first mining operation I did which was with my uncle. Dude, we were basically paying subsidized electricity costs, which translates to our electricity costs were basically free. We had to eventually pack up and move because, like, basically government officials started to catch up on, you could basically buy these machines and they're basically money printers, right? Because you don't have to pay for electricity. And we had to pack up and go. My uncle went to Washington State, and I went to South Carolina. But that's fucking interesting. I haven't talked to a fellow miner on the podcast, so I'm very happy that you came on, dude. That's awesome.
Thanks for having me.
Cool. So you said you were talking a little bit, I think I touched on this topic a little bit with Ethan before, and you were talking basically about how the hash rate it will be some sort of commodity. Could you go a little bit into that?
I'll actually let Ethan answer that, and he, I think, does a really good job explaining the future of that marketplace.
Yeah, I'd love to hear the backstory more of Venezuela too, because I know a few mining farms just got seized in the last week, so some interesting developments there. But on the topic of hash rate as a commodity, really this comes as a realization of years in the mining space. JP's built a number of mining companies over the past few years. I had a mining farm go bankrupt in Kansas City in 2018, and as part of that journey, really realized that at the end of the day, all you care about is like, what's your revenue per machine? And so if you start looking at it from that lens, you start realizing that hash rate itself has a value. And that value can be traded, it can be transferred, you can build financial instruments on top of it, all with the idea that miners take a lot of risk in their operations. You guys have both taken a considerable amount of risk, and you're betting basically on the future revenue of your machine. Same with your clients who are hosting with you. So if there's any possible way to transfer some of that risk to investors or traders, I think it'd ultimately benefit the ecosystem quite a bit.
That sounds awfully like derivatives, my friend. That's what I'm smelling in this. Like, you're basically creating a derivatives market off, basically you're just leveraging the risk, right? So if a miner wants to sell, if he wants to basically lock in a certain price, perhaps someone else wants to take on that risk, right? Is that correct in assuming that?
Exactly. I think as a miner, you can still transfer risk, like hedge away some of that hash price or the value of hash rate risk, but still have like outsized returns. Someone like JP, like he's building out mining farms in very low cost areas. He knows the CapEx cycles pretty well. He knows when to sell forward his hash. Like in an operation like that, you can still benefit from hedging out the value of your hash rate and still get outsized returns, by running efficient operations. To date, there hasn't been very many tools for miners to transfer some of that risk, and that's probably why we've seen a lot of boom and bust cycles where kind of the more inexperienced miners like me will invest in like what looks like a really good investment, and then a year later the value of hash rate is completely different, and it goes it goes bankrupt or something in that nature. So I think we're going to start to see a new paradigm shift in North America around these derivative instruments, and really usher in a new level of institutional capital. JP can probably speak to that in more detail because he has quite a few conversations with more institutional level players trying to get into the mining space.
Absolutely, man. That's really interesting, dude. It's just it's more so. Do you fear? And the question. This is a question for you, JP. Like, do you feel, because this is what I felt a lot, and I've been offered at least 2 or 3 times to basically buy my mining operation outright, but I kind of have the luxury of the gentleman that owns the property in which I mine. He's made his money already, right? And he's just kind of looking for passive income, and I'm doing basically all the heavy lifting, right? So I kind of have the luxury of the guys. He's not really hungry. But do you feel like there's a consolidation of mining, right? So basically the smaller players are just becoming bigger players, and then they eat smaller players and they just get bigger and bigger and bigger? Do you feel like that's happening?
Honestly, no, due to the fact that I think in the mining space, M&A is really hard because the one thing that matters is your electricity price. So it's actually more efficient and more effective to go to a spot with a lower electricity cost and to build out new facilities than it is to acquire facilities that have rates in the 4 cents or 4.5 or 5 cent range. Mm-hmm. That's just simply because electricity, is a commodity, and that needs to be used immediately, unlike oil or natural gas where we can store it and we can use it for a future date. Really, hash rate and electricity go hand in hand where you have to use it today. And so that electricity price plays a massive role, even more important than the CapEx required or the multiplier you might get on a site.
Awesome. So just to be clear, like on my website, I advertise, I think it's 3.5, but in reality, we're getting lower than that. I think I've told Ethan off the podcast, but it's just because of the nature that I'm in, you can't tell everyone your secret sauce, and you're in mining, so you kind of understand that concept, right? So yeah, man. So let me ask you something else. What are the most common what is the most common operation that you see nowadays? Is it a large mining operation? And what states do you see that mining is occurring the most, and why is that?
Yeah, so if we're specifically talking just about the United States, I think where we're seeing a lot of facilities come up is Texas, just because of the energy markets there. So Texas, for those of you that aren't very familiar with energy, it's an unregulated market. It's not regulated by the federal government, which is called FERC, the Federal Energy Regulation Committee. They built their own market, which allows for really a lot of competition, a lot of energy producers to come in and to wholesale into the market, but it provides Bitcoin miners the opportunity to basically buy power for very, very cheap. And that's kind of part of the nature of the mining industry and how it's integrating more with the grid and how we're helping kind of when it comes to peak load and peak demand, we're helping hedge that off so that these grid operators can understand that we provide consistent demand, but have the ability to turn off instantly and are not going to lose a significant amount of profits or not going to hurt our actual processes while we're being down. But the utilities at the end of the day are the ones who are the winners because we're using consistent power throughout the night, usually when the power prices are the lowest.
Gotcha. So I'm assuming that in Texas, you guys are using some type of natural gas for energy. Is that correct?
Actually, so in Texas, it's a lot of grid-powered operations. Just the nature of the wholesale markets there, and being able to build your own substation allows you to get past the delivery charges, which range between $12 to $14 a megawatt hour, so 1.4 to 1.2 cents a kilowatt hour.
Oh wow! Holy crap! Really?
That's just demand charge. So that's your charge above the energy cost. So usually raw energy in Texas trades between $22 and $27 a megawatt hour. Right now it's actually crashing just the market in West Texas and the energy markets in general in Texas, because we've seen a constant supply of renewable energy, which produces energy in the low teens compared to the natural gas cogen plants that have been built up over the years, which produce energy in like the $20, $25 range. Just in West Texas alone, I know there's going to be at least 10 gigawatts or more of wind and solar energy scheduled for till 2022. So there's a ton of energy and there's not enough consumers. And that's a lot because of the federal incentives and tax credits we have.
Okay, so is it so first of all, man, those prices are fucking incredible. That's like China prices, man. That's crazy. And this is kind of a question for Ethan and for you, JP. So Ethan touched a little bit on basically these derivative products and financial institutions being interested in that. So let me ask you, JP, what type of financial institutions would be interested in that type of product? And for you, Ethan, the question would be, how would you make that type of product? And is there some form of regulation for that type of product? How would you go about doing something like that?
So institutions, they specifically are looking to just hedge their risk in any type of transaction and would prefer steady yield, especially in this zero interest rate environment we're in. So the ability to take energy and turn it into hash rate, which is really Bitcoin mining at its core, provides a huge opportunity, because for the past 10 years, this industry really hasn't been a bankable industry. It hasn't been one where credit terms have been beneficial and have been attractive. And what happens with that is that means there's a huge opportunity for the private capital to come in, for institutions, for private equity to come into the space and take that spread there, where, like I mentioned, you're just taking the electricity cost that you have, which is usually flat, and you can save that for about 5 years. But what we don't know is what the future value of hash rate is going to be, and that type of security and being able to lock that hash rate in for even 3 to 6 months.
Let me elaborate a little bit on that question, and then I'll let Ethan answer my second question. But which is basically, dude, that's a lot of fucking risk, man. You're in mining, you understand that. Like, who would want to take up, because that's a huge bet, right? Someone taking up that type of risk. Like, who would want something like that? Like, is it an institution that just wants a crazy return? You know, I'm a little bit confused there.
Yeah, so I would say at the kind of like, mining really isn't, in my eyes, that risky of a business. If the hash rate that you're buying, or when you're buying, when you're deploying a mining facility, if the hash rate isn't overvalued relative to the market over a longer term trend, and you're seeing that it's not in like a bull cycle, you can deploy a mining facility and make a pretty steady return. It really comes down to that power cost. That is like 98 to 97% of the cost of running a facility, especially at scale. And so that's the most important thing to focus on. Really, in my opinion, Bitcoin mining and mining in general, it will be seen as almost like a safe haven or an asset class that investors can diversify into. especially where interest or return on investments in real estate and commercial real estate and other areas keeps on dropping, even with the shale boom kind of ending and oil crashing. There's been a huge issue with industrial and debt-based investments kind of getting their returns squeezed. And mining has this huge opportunity because the credit space and the bankers haven't really played around in it because it's touching Bitcoin, and because it's a new industry. It's still 10 years young, and we have 90 years to go. So there's a lot of opportunity for these financial products to be built on top, which will help take that risk away, and we'll kind of steady those rewards out.
Awesome. So Ethan.
Let me just add on there. I think JP hit the nail on the head in terms of making this investment attractive for people coming into mining. I think the taking the other side of the bet, so going along the value of hash rate, that's kind of like who's taking the risk from the miners. Those are going to be in the future trading desks in Chicago, New York, maybe Houston. Those are guys who are ready to go 2-3 times leveraged on oil futures or trading hog mix or wheat or whatever. And so this is really just another commodity for them to play with. They're very comfortable trading in volatile asset classes and placing educated bets on it. I think hash rate is a really interesting asset class that these guys are going to enjoy trading. Like JP mentioned, it's ephemeral by nature. You can't store it. It's most similar to electricity, where you got to use it right away. And so it's a very interesting asset class for trading desks around the country to engage with. And these are guys that may have never even been in mining, but they have some form of educated view on how the market's going to go and want to place a large bet on it.
Do you feel like the traditional financial institutions would be interested in something like that?
It'll probably take some time before you get a Citadel or Jefferies trading hash rate. Those are kind of some of the bigger players in general commodity markets. I think the first step will be getting people who trade crypto derivatives right now, who already trade on CME or trade FTX, BitMEX, Deribit. Those types of prop trading desks in Chicago will likely be the first adopters of this new market, because I do think there's outsized returns here to be made on the market. If you look at FTX difficulty futures, I think they're incredibly mispriced. I was saying buy them a few months ago, and now they're way up as people realize that there's going to be quite a bit of hash rate coming onto the network. So I think there's opportunity for these prop traders to make a lot of money. And then I guess longer term, maybe 5-10 years from now, we'll start to see the Citadels of the world engaging with hash rate as a commodity.
Okay, so let me ask you another question, and either one of you guys could answer this. What type of caps would an investor be looking for? What type of yearly return? It's just I'm a bit confused with that.
I think from an investment in mining perspective, the value proposition of hedging instruments allows you to lock in some certain percentage. You go from an investment that could either yield you 100% or zero to investment that's probably going to yield you 35-40, or for the best operators. But JP probably has a better sense of what investors are looking for right now. And I guess it depends too if it's hedged or unhedged.
Yeah, at the end of the day, investors are looking to take as much risk off the table as they can. As Ethan mentioned, the return profile of miners is really 100 to 0. Kind of expounding on that is it's a lot of people lose money in mining because they don't get it at the right price, and they're buying when hash rate is way overvalued. Obviously, that's great for the people that are in the industry and have been in the industry for a long term. And those cycles help experienced miners basically liquidate hash rate into the market as the price of Bitcoin goes up. And Bitcoin mining and Bitcoin is a very sentiment-driven investment. Most investment funds and most companies out there currently don't have they don't have people going out and really looking into this space. They don't have people doing research and bringing this as an alternative investment class, because it brings a lot of stigmatization to it. And it says, oh, Bitcoin's still at $10,000. One of the questions that we get a lot from investors is, how much money am I going to make if Bitcoin's at 10K? And the kind of my response back to them is well, it depends on when it's at 10K. Bitcoin's been at 10K for the past 2 years. If it was back in 2018 when it was at 10K, the hash rate value is close to $1.40. Now Bitcoin's at 10K, it's 7 cents. So it's very hard to answer that question on the price per Bitcoin, but that's where everyone's kind of mind is. It's, oh, Bitcoin price is up, mining should be more profitable, let me get in. And that's really how investors get burnt compared to, oh, Bitcoin is flat, difficulty starting to rise, but US dollar per terahash is still, still stable and has been providing great returns.
I understand. So let me do two follow-up questions to JP. So, and Ethan, maybe you can correct me on this, but from institutions, man, they're looking for a steady return, right, on a yearly basis. So like you can't give me an answer like off the top of your head what someone would be expecting. And let me ask another question on top of that is, how much interest have you seen from institutional investors or investors in general?
Yeah, so the institutional investors are definitely coming to the table, especially with COVID. I think it changed how institutions and how we view central banks integrating in our economy. Now that they're buying financial assets for 0% interest rate, it's really affected the environment landscape as a whole. Bitcoin mining and kind of what investors want to see, anything above a 12 to 15% IRR is considered a great debt investment for any other investment.
Absolutely.
Outside. So for Bitcoin miners, since they do have this stigma of Bitcoin being tied to it, usually we see investors get excited around the 30%, 35% IRR range, which is very easy to achieve with power rates all across the United States. As you begin to lower your power rate and bring it down by 1x, 2x, 3x, you begin to see the returns of Bitcoin mining, as you mentioned earlier, like in Venezuela, they become astronomical. You can get hundreds of percentage in IRR, so 200%, 100%, depending on how long you're running it, when you're entering and exiting the market, and just being an efficient operator at the end of the day.
Got it. So, and one of my last questions for JP, of course, I'm going to ask you more questions throughout the podcast, but and then we'll move on to Ethan. So, man, 20 to 30% is wild, but do you think that type of return is going to last over time? Do you think that, or is this a short-term opportunity because of Bitcoin's current rewards, like mining block reward?
No, I think 20 to 30% is pretty, we'll see that for at least the next probably 7 to 10 years. I know that's a long time out, but you could expect to have a 30% return with proper management and your electricity costs being low enough. So like in Texas, where the electricity cost is 2 cents and we know there's tons of generation coming online, it's going to continue to get lower. Miners are going to continue to help the grid, continue to get some of the credits back for doing that. I expect that return profile over a long period of time to be pretty normal and to be something that will squeeze as more debt comes in the space. The biggest players I see coming in the space in the next 4 years are really energy companies. We've already seen them kind of look at it, and now this is where we expect a lot of capital, especially as Bitcoin price rises, because those players have energy for super duper cheap. So even though they're buying hardware for let's say it's overvalued, number one, their capital is close to free because they have great credit terms, they have great banking relationships. And number two is their energy costs is close to zero. It's as cheap as they can get it because they're the ones generating it. So those players, I think, will come into the space in the next 2 years when Bitcoin price goes up, and they will stay in the space because they can maintain their profitability.
Man, that's really awesome. That's so exciting. It just gets me so exciting because it's basically, I don't know how else to put it, but it's basically legitimizing. And I hate to use that word because it was already legitimate, but like it's basically legitimizing this industry in a way, right? So that's really cool, JP. I'm gonna get back to you, but I want to talk a little bit about what Ethan's been working on because that's why he initially messaged me. And let me pull it up so everyone sees what I'm looking at. There we go. Awesome. Wait, wrong page. Where is it? Sorry, guys. Here we go. There we go. Okay, so this is hashrateindex.com. This is what Ethan has been working on, and I want him to kind of explain to you guys what this is about.
This was really a side project our team decided to build because we see the industry developing and we want to help bring more hash rate to the US specifically. And we think the main factor in that is making a market and an industry that's more sophisticated. So to date, most of the industry has been relatively opaque. And JP can probably speak to this best, but ASIC manufacturers, it's really hard to understand how they price rigs, how that changes over time, things like that. The value of hash rate is incredibly hard to value. It's traded to like black box mining pools where you don't really know the price you're getting. So this website is really just us trying to help the industry move forward, build out some of these data visualizations and help people start to see that this really is a true market and a true commodity, and help it grow up professionally. So this page, if you scroll a little bit up here, it was really what JP and I have been talking about, which is this revenue per terahash idea. This is exactly how much miners make for their efforts. It's a really interesting asset class. What are you at, 6 months here? You can see that historically it trades mostly in backwardation. So the value of hash rate decreases over time. That's because machines get more efficient, more machines get added to the network, and the network difficulty increases as a result. But that it also gets reflected in the cost too. Like everyone's creating more efficient mining operations, installing better hardware, so your dollars per terahash on a cost basis is also decreasing. There's really like interesting times to observe here. Like you can see that there's times where the price shoots up. JP was mining, and so were you, I guess, in late 2017 there when revenue per terahash was above a few dollars. Like that was a crazy time to be in the game. Really outsized returns there. We see that a lot with different like spikes over the next few years when Bitcoin price spikes. So yeah, this is really a tracker just to look at how much do miners make right now. And on the top there, you can see that miners right now are making about 7.3 cents a terahash. And that's how much mining pools are paying them for their hash rate.
So if you were to create kind of like a financial product off of this, this is basically the price, right?
Exactly. Like if you look at how oil producers hedge their risk, they hedge on like dollars per barrel of oil, right? And that's really the only way that oil producers can hedge.
Let me back up a little bit because I have my suspicion is a lot of people don't understand how the futures market or how derivatives work. So could you explain a little bit? Because I know Ethan worked at Goldman, so he could give you a grade A explanation. So could you explain a little bit to everyone who's listening or watching, like how does a derivative work? How does it benefit I would say the producer, right? Could you kind of get into detail and kind of simplify it in a way?
Yeah, there's a few different derivatives at play here. So we'll walk through a few examples. The first is like a hash rate forward contract where we're actually starting to see.
Let's back up. Like just a traditional derivative that someone could. It's very easy for them to understand, and we'll get into the Bitcoin or future hash rate derivatives. I just want everyone who's watching and or hearing to kind of understand what's going on.
Yeah, I mean the most simplistic view is that a derivative is really a financial tool where two parties engage in some type of contract and lock in a price in a future date. So you and I are betting on the future value of hash rate, and then we lock in a strike price, 12 months from now, and we're betting what that price will be in 12 months. That's kind of the most simplistic view of a financial tool like that. Now, in that realm, that's a very simplistic view, but there's a few different products you can build. So like this hash rate forward contract is basically you and I, you as the miner will sell me your hash rate forward. So I pay you up front for that hash rate, and then you deliver it to me over the lifetime of the contract at our agreed upon price at the beginning. We're starting to see that that's developed for a few years. Like people like Genesis Mining have been selling hash rate contracts. BitUda is now brokering forward hash rate contracts. That was kind of like the first play into like derivatives in mining. And so the basic principle there is that it allows me as the miner to offload some of my risk to someone. I lock in a certain price for my hash rate, they pay me up front, and then we continue on. They're making a bet basically that the value they pay is going to be less than what it's actually worth in the future.
Okay, so just for everyone to understand, you're basically the miner, right? In this case, he he doesn't want to take the risk, right? So he sells it to someone else that's willing to take the risk. And then the benefit for the miner is that you get a locked in price, right? So someone else is taking the risk of the volatility because you just don't want to take that risk, right? So it kind of benefits both parties, because the party that buys that risk, and correct me if I'm wrong, Ethan, kind of, he's like, you know what, I want to aim for, I'm just throwing out numbers here, guys, but he wants to aim for the 30%, but the miner's like, you know what, I don't want that risk. I'm going to aim for the 15. So I'm going to sell it to someone who's willing to take bigger risks because I know for sure I can get paid now. Is that correct, Ethan?
Exactly. So like on the screen, we just saw that hash rate's worth 7.3 cents a terahash. If I wanted to be risk adverse, I would sell you forward my hash rate at say 6 cents a terahash for the next year and a half. Now I'd take a haircut on the value of my hash rate right now, but I know that my investment return is going to be stable. I already know my cost because I know my electricity cost, my OPEX, my machine, efficiency, and now I can lock in my parts of my revenue. So now I can guarantee an investor, or get pretty close to a guarantee of like a stable return. And depending on my operations, that could be something like 25, 30%. And it's almost locked in at that point. And so regardless of what happens to the value of hash rate, I'm always going to be selling it to you at 6 cents. It could be at 5 cents and then I'm better off. It could be back at 7 cents and I made a bad bet, but ultimately it reduces the risk in the operation.
Awesome. That's really cool. So, and Ethan, is another question for you. Like, how would you build this type of financial product? Like, could you walk us through? Because, could you walk us through the process right now that everyone knows how this would work?
Yeah, so these hash rate forward contracts I talked about are already built, but they're also not as interesting, I think, long term. And the reason is because miners are going to go short the value of hash rate. They're going to take a short-term bet on it. That's the way they can hedge their operations. So you need somebody to take the long position, like a trading desk or a non-miner. You want to make it as easy of an experience for them as possible to engage with this asset class. So I think more of like a future type instrument where the hash rate's not actually physically delivered. You're just purely placing a bet on the value of hash rate. That would be quite interesting for the market. To build that, you need to go then build a futures exchange, where if you do it overseas, it's actually quite easy. You can get a white labeled solution from one of the existing exchanges and then go build it in like Singapore, Hong Kong. If you want to do it onshore in the US, then you need to invest some heavy legal expenses. It's going to be regulated by CFTC, SEC. You're going to need your DCM license from CFTC, your swap execution license, potentially money service business licenses. So if you want to do it correctly, you're going to need to get into the house of all the regulators. But I think we'll eventually see this market develop, whether it's onshore or offshore. It's definitely needed by the industry. And maybe there's an option for both. Right now, there's a lot of Chicago trading desks that are trading offshore products. Like you see, there's Chicago prop trading firms that are trading on derivates. That's not regulated in the US. But if you want to access the pools of capital in New York, the more institutional and professional capitals, you need to be regulated. So I think there'll be a point where there's onshore and offshore options available, and they'll access different pools of capital.
Cool. So, just for everybody that's listening, basically right now, these exist, which are basically forwarding contracts. And in a way, it's weird because Genesis mining, yes, you are buying a forwarding contract, but it doesn't really feel like it, right? And then what you're suggesting is what's going to happen, like in the foreseeable future, is basically futures contracts, right? And that essentially what it is it's a miner that doesn't want to take, or he wants to get a steady return. So he's basically selling potential profits to someone who wants to take up that risk. Is that correct? Summarizing all that?
Yeah, I mean, Genesis Mining, they've benefited from how they sold into the market, and JP can talk on this too a lot, but it's not exactly a marketplace, right? Because they're one entity setting the prices, and they're basically serving up cloud mining contracts to retail and being like, here's the price that we're offering at it, take it or leave it. There's no market-based pricing. So I think in the future, like the more long-term products will have market-based pricing where a bunch of buyers and a bunch of sellers come together and the price is determined by the market, not by a single entity.
Okay, cool. Awesome. So that's really exciting. That's really interesting. Man, it just gives me goosebumps because I just see the future of where this industry, this crypto space is going. And I remember just starting out in JP for you, 2013, bro. That's wild, you know. So like you're almost an OG. I would say you're in the line of being an OG. So, dude,
7 years.
that's fucking wild. So I want to get into a little bit more about JP and what he does, because he does what I do, but basically on fucking steroids. So let's talk a little bit about that. So did I pull it up? No, there we go. Awesome. Okay, so this is JP's dope website. Don't go to it. Go to mine instead. I won't give you better prices, but I'm awesome. So so you offer hosting, basically the same shit. Man, what is the Bit Cave? Can you explain a little bit about what that is?
Yeah, so the Bit Cave is a 40-foot and 20-foot mining container where you can run and deploy miners directly at a power source with very low infrastructure costs. The nice thing about these is they can be deployed very quickly. And as I mentioned, they use the power there, and they're not like a building where you're going to invest in infrastructure and be stuck to one physical space. And if your power rates change, the utility jacks up your prices, you kind of stuck with them. This allows basically Bitcoin miners to chase the lowest cost of power. At Mining Store, we have been focused on serving that type of kind of retail customer for a while. Over the past, I guess you could say, year, we've really started to position and target ourselves more to those energy companies, as I mentioned. So looking at projects kind of in the scale of 100 to almost 400, 500 megawatts. Really where those projects come in to scale is with large energy companies who have stranded assets that are not being utilized fully. Power plants have to run about 98, 97% of the time to really make a profit. If they're only running for 3 or 4% of the year and they're only providing power during those peak hours, they're not going to be making any money. So we're working with a couple different energy companies on basically building out these large mining sites directly where the energy is produced.
Absolutely. And so you found a lot of interest basically from power companies themselves.
Power companies, energy funds, any type of private institution that owns energy generation assets, power traders, as Ethan was mentioning, guys that already speculate on these assets. Those are the groups of people.
Wait. Hold on, time out. This shit fucking sucks balls. I just want to say that.
Hey.
All right, who are you saying? This thing fucking sucks. It looks good, but it fucking sucks balls. Okay, anyways.
I've never seen that miner. What is that?
The website needs updated. We don't sell individual machines anymore. If you actually try to come to our website and buy one machine, we'll tell you we won't service you. So
okay. Yeah, you just dump the shit. Yeah, I feel you. I feel you there. I still use eBay, bro. No, but
What manufacturer is that? What is it?
Dude, bro, it sucks though. It's broken. My shit fucking broke.
It looks cool.
Yeah, it looks fucking dank, but it fucking sucks balls. That's why I had to say that. I'm sorry. But yeah, so man, this website's fucking cool. I don't know what this shit is. I don't recommend it. Like I said, don't go to the Mining Store. Go to my website. We're more expensive, but we're dope. Oh, is that you?
That's me, man. Back in 2017, that was that solar farm deployment we did, or 2018.
I can't. There we go. Oh, that's JP. Okay. Sorry. Anyway, so this is pretty cool, man. So let me ask you something, because we tried to, in my case, we tried to go solar, but we realized that it just wasn't worth it. So could you go into a little bit about what you've been doing with solar, how it's working? Could you go a little bit in depth? This isn't solar, but I just asked you that question.
Yeah. So that solar farm project, let's see. They basically said they needed to use their energy to get production tax credits. And in order to qualify for those tax credits, you have to consume the power that the energy that the solar farm is generating. They called us up in November, and they had to do it by the end of the year. And by the December 10th or 12th or somewhere like, midway through the month, they were like, let's do it. So we set up this project for them, get the container deployed, and by the end of the year, it was running on solar power, which then gave them the California approval, and then they were able to say, hey, we're using solar power to do something, and we want a tax refund. Solar mining at scale and for miners, in my opinion, it doesn't really work, but I've seen some really interesting projects of people that are doing it at scale that I think are worth mentioning. So one group is parking thousands of trailers in the desert of New Mexico. Each one of those trailers has solar panels on them. They have batteries on them, and they run 2 Antminer S17s. Each trailer, and we're talking thousands. So these come off production line, and they're backed by Warren Buffett and Berkshire Hathaway, and they're just using the tax credits, the depreciation of the assets, and the renewable credits to mine crypto at scale. So I think innovative solutions like that, with using batteries to run miners and getting those credits, really help. And we'll see that merge in the following years. But it's really you need multiple things of generation to run.
Awesome. That's cool, man. So essentially, that's what I thought, because I was just like, how the fuck did someone pull off? But it's obviously because of the surplus. And I'm going to go a little bit into that question, JP, and then we'll do kind of like the speculative part of the podcast. And I just want to get your guys' thoughts, and we'll just go into that speculative territory, which is why I save it for the end. So JP, could you kind of, I've answered this question many times, but it looks like you have tremendous amount of experience in the mining industry and mining in general. And obviously you're a Bitcoin fan. So could you clear up the fucking misconception that mining uses a lot of energy? And I'm just going to drop in a little hint here, so you kind of know what I'm talking about. I'm just going to say surplus, right? So could you, what are your thoughts on this?
So in my opinion is Bitcoin miners have the opportunity to revolutionize the grid and how it works. Bitcoin mining, it does use a lot of energy, but that's not a bad thing, especially when we have to use the energy we're creating. As Ethan and I mentioned, there's really no good way of storing energy as a commodity. Battery storage is coming up, but the reality is you have to use the energy. So one of the biggest problems for utilities across the world and across more specifically across the United States, is the fact that they're no longer in the energy generation business, and they're really just in the business of selling power to customers and service and basically trading that power. So in order for them to reduce the amount of people they need on staff and the amount of power plants they need available or be able to call on to get the power generation turned on during those really hot summer months, it's very costly for utilities because, like I mentioned earlier, these plants are only running 3 to 4% of the year. So what happens is that Bitcoin miners can provide almost like a buffer between what the real power usage is in the community and what the actual power usage in the community. And so what I mean by that is that Bitcoin miners have the ability to react in seconds and to be able to turn off their miners and be able to reduce their power usage next to zero, which then actually saves the utility company money, but more importantly, it saves us from having to turn on diesel, old gas-fired power plants, coal-fired power plants that have been around for maybe 30 years from harming the environment and from putting out extra emissions. Because we don't have to turn those plants on, because we're able to subsidize the load that we are currently providing on the grid with just renewables. This provides a huge opportunity for Bitcoin mining because, like I mentioned, now you have a synthetic load that's really can be turned off at any moment on the grid. So when we start to approach those peak hours during the hot summer days, we are then able to turn off those machines, and the customers, the grid gets the power back. And this allows them to not have to turn those plants on, which helps save the environment.
Awesome. Yeah, so that's the fucking misconception, man. And everyone just is like, Bitcoin uses more power than the country of Denmark. I'm like, dude, you don't fucking know. Look up efficiency and surplus. That's all I'm going to say to you, motherfucker. And then they just don't get it. But dude, thank you so much. It's so fucking awesome just listening to a fucking miner that started in 2013. That's fucking dope. So let's get into a little bit of the speculative territory. And I'm going to start with the with the ex Goldman Sachs, trader. He just moved to the crypto industry. So, dude, it's actually so funny. Let me sidetrack a little bit. So I sent a buddy of mine that works at Goldman Sachs, Goldman Sachs Miami, and I sent him the video that me and Ethan did. And I was like, dude, when are you going to come to the dark side, bro? When are you going to quit? And he's like, bro, fuck you. Bitcoin's this and that. I'm like, yo, shut up. And then he sent me, okay, remember, Ethan, that you tweeted about it too. So remember that Goldman Sachs basically tweeted how but it's more from their wealth management standpoint, that they tweeted that Bitcoin isn't a viable investment at the moment. What were your thoughts on that?
Goldman's a really big organization. So it was like some low-level guy in asset management that was advising his clients not to buy Bitcoin. Doesn't necessarily represent the whole firm's view. I think Goldman does see the value in Bitcoin across different arms. But these organizations are huge, and you have to take that into consideration. Same thing just came up with Fidelity. Everyone's talking about Fidelity buying Hut 8's public offering, one of the bigger miners up here in Canada. But in reality, it was Fidelity Canada, which is like very distant from the Fidelity Bitcoin mining team we all know, who's based in Boston. So I think whenever these large organizations like put out some piece or something, whether it's Goldman, Fidelity, etc., you have to really look into what division was it, who was it, because they're not like the three of us here where they represent their firm. They're like one clog in the machine of like tens of thousands of employees. So that was kind of my thought on the Goldman take. But I think it just generally like how I look at large corporates that talk about Bitcoin.
Okay, cool, awesome. And no, I just wanted to touch on that because I just thought it was funny, but that's awesome, man. Cool to hear your thoughts on that matter. But and I'm gonna put the actual statement down in the description so you guys know what the hell I'm talking about. But I wanted to kind of, near the end of the podcast, I wanted to get kind of into the speculative territory. And Ethan, I would love to hear your thoughts, and JP, yours as well. What is your prediction for, and I want to talk about the hash rate, because I usually just talk about price prediction, which is just bullshit, but I want to talk about price prediction and I would say hash rate as well, because and JP, maybe you could add some thoughts into it. I come from the thought that the hash rate basically is what gives Bitcoin value, because essentially, like, if you just look at the software, right, like, dude, anyone could run the Bitcoin software and start their own chain, but what gives Bitcoin value, at least to me, right, is essentially the hash rate, because that's basically chain security in my eyes, right? So JP, what are your thoughts on that?
I agree with you completely. Bitcoin has value because of miners and because of the network effect and the security that they provide over time. That continual effort to secure the network to ensure double spends don't happen and to ensure the network is always running is why Bitcoin has value. There's lots of chains out there, and that's really, at the end of the day, Bitcoin miners use the most energy by far to secure that chain. The reinvestment of capital and the introduction of new capital and energy companies into the space continues that chain throughout the years. Also, the halving plays a very important role in accelerating that and kind of making this a very fair but hard competition and industry to be in. Regarding predictions, I don't think the US dollar per terahash will ever get over $1 again, unless the dollar hyperinflates, but that's a whole nother story. And I don't think that will really hit even 50 cents in the next bubble. I mean, we're at 7 cents, even a 4 or 5x increase. That I think we'll get very close to 50 cents per terahash, but I don't know if we'll hit it.
So, what is so JP, and then I'm going to go to Ethan. I hate this question, but I love it anyways, because this is great conversation. What is your price expectation for the end of 2021?
Ooh, 2021. That
December 2021. What's the price of Bitcoin going to be at?
I would say 75K.
Ah, dude. Okay, Ethan, you?
Just quickly on JP's point on hash rate. I think that's quite interesting because as we were talking about earlier with like the stable like 20-30% IRR over the next few years, I think that really comes down to like the value of hash rate. So if we see a large run up in price, like up to that 75K level, we could get back up to 50 cents a terahash. I think a big consideration on this bull run versus last is now there's so much excess capacity of machines that aren't plugged in. There's probably like 140, 150 exahash or maybe more miners out there where like 30, 40 exahash are just like sitting on the sidelines ready to go. Which means that if we see a huge run up on price, immediately people will turn on their machines, which wasn't the case in 2017, right? Like everyone who had a machine was already online, and the manufacturers couldn't get the machines out the door quick enough. So I think JP's estimates on the value of hash rate is really good, and that if we do see another bull run, we won't get over that $1 mark, but we don't necessarily need to. Like 50 cents a terahash, like with like some of these operations like you two, like you guys would be laughing. It'd be, you know, very outsized returns. On the Bitcoin price, I'm like bullish long term. I mean, I just left my corporate job to do this full time. I think all in everyone's head, like we have these like wild price expectations, and we wouldn't have like done this otherwise. We wouldn't be on this podcast right now if we didn't think that there was some ability for like really large run up. I think like JP's price expectations, that's pretty bullish, but I think it could be the play if we start to see you know, another cycle come up here.
Cool. So what's the price? What's the price, man? Give me
What's the number?
Wait. Like, hold on. Let me dox my buddy. Doug, come join the dark side, bro. Leave Goldman. Come to me. Okay. Anyways, what's the price, bro?
I'll caveat this by saying I still think you can build really good mining companies at a 10K Bitcoin price, right? Like today. Of course, you want to look at it on a hash rate revenue terahash basis, but I think like even now you can invest and still build really good companies. But so like if you're forecasting, I put in 10K Bitcoin price. And
2021 10K.
If I'm building a model, but hey, if I'm talking about like what I'm hoping for and think, maybe like 50K.
50K. Okay. Conservative. You guys are conservative. I know like at night you're like, it's 150K, but you want to come in a podcast, you're like 75, 50, you know, you want to sound conservative. That's cool, man. I appreciate that. That's cool. So kind of want to like, so to basically wrap this up, I kind of want to ask a question for each one of you. So for I'm going to start with JP, then I'm going to move to Ethan. JP, for you, if someone were to start mining today, because I get this question a lot and people get excited, you know, they have like 100K to their name. They're like, I want to start mining. I usually tell them like, don't even bother. But if someone were really, really excited and they want to do it anyway, right? They had no expectations. If they just wanted to get into mining, what advice would you give them? And what lessons, let me add to that. Let me elaborate a little bit. What lessons did you learn that like over, you know, basically your experience that you would want to teach your previous self and to teach someone else or to tell someone else that was getting into mining today?
So I would say the two biggest things about getting into mining is timing and portfolio management. Timing is a great time right now. The market we're not $50,000 Bitcoin price, not $70,000 Bitcoin price. We're not even 20,000. If that Bitcoin price gets to that level, that's the time you actually don't want to get into mining because everything is so expensive. As Ethan said, the manufacturers price the stuff. There's really no way to price it. So if you get into mining, now is actually a better time than when the Bitcoin price is, you know, what we call overvalued. Back onto that portfolio management piece, what I would suggest and tell a lot of people to do is hold on to your crypto as long as you can. Try to find credit facilities or investors that would be willing to give you cash to pay those power bills and take out a small, like basically loans to pay those power bills at an 8%, 10% interest rate. And over the next 2 years, holding that crypto, you'll see an astronomical return. When we got into mining in 2013, we were mining 500 Ethereum a day as a company, and that was from a small Ethereum mining operation. Portfolio management on that Ethereum means you're mining $500,000 worth of Ethereum a day, and that's revenue. So that is an insane amount of capital, and that was only 2 years later that price, you know, hit the $1,000 mark. So really, at the end of the day, ensure that you are really getting into the space at the right time. Portfolio management. Number 2 is most important. The number 3, basis of your operation. If you're looking to buy miners and say you have $100,000, that gets you right around maybe 22 to 25 new units. You won't be able to run those in your house. So really work with a hosting provider who's going to work with you. Work with someone who is incentivized to ensure that your mining operation will be profitable throughout any downturns in the market, but then also that they're going to help you exit and liquidate that equipment at the end of the contract or when the miners are done. The most important thing in mining is basically to remember that the miners are a steel box that by the end of the day have no value. So it's important that when you're getting into the space, you understand that if you hold on to the hot potato for too long, it's not going to be worth anything. So you need to be able to sell it when the hot potato is expensive, when the Bitcoin price is 75,000, because that's how you're going to recoup a lot of your money, and that's how you can be a successful miner.
Awesome, man. That's great. It's great advice. I love it. And so, Ethan, a question to you is basically, what future plans do you have for Luxor Pool? Do you talk to me about that? I haven't touched on that this whole podcast because I knew that you wanted to talk about your website. So, just talk to me a little bit about Luxor. What's going on with that?
The recent focus has definitely been a lot on Hashrate Index. Really trying to build out this data website. It's primarily user driven, so we really appreciate any feedback that people give to us, whether it's new feature requests, things they want to see added, that sort of thing, and then we can go and build it. So both of you and anyone listening, like if you guys have any ideas of like cool mining statistics that you want to see, let us know and we can build it. That's been a big focus of ours. I think from the Luxor mining perspective, we're really trying to experiment in profit switching algorithms. Historically, China's dominated mining and the West has dominated quant funds. But now we're bringing quant funds into mining. We're now bringing quantitative algorithms into the actual management of hash rate. And so this could be one avenue that that hash rate actually now becomes managed by more North American and US based entities. So we're really excited to continue to develop those switching algorithms. We've focused primarily on Equihash so far, which is like Zcash Ryzen, mostly because it's cheaper to make mistakes in. But we're starting to see really good returns there, about 6% over the base currency, which is Zcash. So the next goal is to bring this algorithm to SHA-256 so we can get that uplift over Bitcoin mining and really bring more hash rate back to the US, which we think is really important for the security of the network, which we also talked about last video too. I think bringing more hash rate to the US is going to be important for Bitcoin as a whole as we look to decentralize where that hash rate's produced and increase the security of the network.
Cool, man. That's really exciting. That's awesome. I'm really looking forward to it. And yeah, dude, I'll definitely, and I'll talk to other people. Definitely, man. If I think of something, of some mining metric, that I'd definitely talk to you about it. But it's really awesome. I'm really excited. And guys, thanks for listening to another episode of CryptoKreamers. There's so much good news in my head that I got excited. But thanks for listening to another episode of the CryptoKreamers. If you guys want to host your ASICs or GPU miners or whatever, don't forget to check out JP's website. I'm going to link it down in the description. And of course, if you want to mine with the best fucking mining pool on the planet, check out Luxor Mining. I'm also going to put that link down in the description. Thanks guys for coming on, and don't forget to tune into the next one.